Imagine you could control 100 shares of one of the biggest companies in the world, and you could do it without spending tens of thousands of dollars. That is the basic idea behind options trading, and today we are going to break it all down in a way that actually makes sense, even if you have never traded a single thing in your life. Stick around because by the end of this video, you will understand what options are, how they work, and the key concepts that every beginner absolutely needs to know before even thinking about placing a trade. So let's start with the most fundamental question. What exactly is an option? An option is a contract between two parties that gives one of them the right, but not the obligation, to buy or sell an asset at a specific price before a certain date. Notice those words carefully: the right, but not the obligation. That distinction is what makes options different from simply buying or selling a stock outright. When you own a stock, you own it. With an option, you own the right to do something with it, and that right comes at a cost. Let me paint a picture to make this click. Imagine there is a concert happening in 30 days, and tickets are currently selling for $100 each. A promoter offers you a deal. Pay $10 today, and we will lock in your ticket price at $100 for the next 30 days. Now, two things could happen. If the concert becomes massively popular and ticket prices shoot up to $150, you can use that deal you locked in, pay the original $100, and either attend the show or even sell your ticket at a profit. But if ticket prices drop to $70, you simply walk away. You lose the $10 you put down, but that is all. You are not stuck paying $100 for something worth $70. That $10 deposit you paid up front is essentially the premium, and the locked-in price of $100 is what traders call the strike price. The 30-day window is the expiration date. That right there is the foundation of how options contracts work. Now, in the real financial world, there are two main types of options, and you will hear these terms constantly. The first is a call option. When you buy a call option, you are betting that the price of an asset is going to go up. You are what traders call a bull. A call option gives you the right to buy 100 shares of a stock at the agreed strike price before the contract expires. Notice that one contract always represents 100 shares, and this is called the contract multiplier. It is one of the most important things to burn into your memory. Here is a quick example. Say a stock is trading at $100 today, and you believe it is going to climb to $120 over the next month. You buy a call option with a strike price of $105, and you pay a premium of $2 per share. Since the contract covers 100 shares, your total premium cost is $200. Now, if the stock rises to $120, your option is worth a lot more than what you paid for it, and you can sell the contract at a profit without ever having to buy the actual shares. That is the power of leverage at work. A 20% move in the stock could translate into a 100% or more return on your option premium. But what if the stock drops instead of rising? This is where understanding the downside matters. If the stock stays flat or falls below your strike price when the contract expires, your option expires worthless. You lose the $200 you paid in premium. Not a dollar more, but not a dollar less. Your maximum loss when buying options is always limited to the premium you paid, and that is one of the genuinely nice features of buying options compared to other forms of leveraged trading. Now let's talk about the second type, which is the put option. A put option is the opposite of a call. When you buy a put, you are a bear, meaning you expect the price to fall. A put gives you the right to sell 100 shares at the strike price before expiration. So if a stock is at $100 and you think it is going to drop to $80, you buy a put option. If you are right and the stock falls, your put option becomes more valuable because you have the right to sell shares at a higher price than the market is offering. If you are wrong and the stock rises, you lose the premium you paid, but again, nothing more than that. One thing worth understanding is the terminology traders use to describe where a stock price is relative to a strike price. When the market price of a stock is above the strike price of a call option, that option is said to be in the money. When it is below the strike price, it is out of the money. And when the stock price is right around the strike price, traders call that at the money. For put options, it flips. A put is in the money when the stock price falls below the strike price. Now let's talk about something called the premium and what determines it. The price you pay for an options contract is not random. It is influenced by three main factors. The first is intrinsic value, which essentially reflects how far in the money the option already is. The second is time value. The more time remaining before the expiration date, the more opportunity there is for the price to move in your favor, which makes the option more expensive. As expiration approaches, this time value decays, and this is something that catches a lot of beginners off guard. The third factor is implied volatility. The more volatile a stock is expected to be, the higher the premium will be, because there is greater potential for big price swings in either direction. Here is why this leverage element is so exciting and also so dangerous. Because each contract controls 100 shares, even a small move in the underlying stock can create a massive percentage gain or loss in the value of your option. A stock moving 10% could cause your option premium to double, triple, or even more. But that same leverage works in reverse. A stock moving against you can wipe out the entire premium very quickly. This brings up something absolutely critical, and I want to be direct about it. Options trading is not gambling, but it can become gambling very fast if you approach it without a plan. Professional options traders do not randomly pick stocks and throw money at contracts. They identify assets they understand deeply, they follow a system with clear entry and exit rules, and they practice strict risk management. One commonly followed guideline is to never risk more than 2% of your trading account on any single trade. Because options can go to zero, large uncontrolled positions can devastate your account fast. There is also a whole other side to options that we have only hinted at, and that involves selling options rather than buying them. When you sell a call or a put, the dynamic completely flips. As a seller, you collect the premium up front, but now you have an obligation. If the buyer decides to exercise their contract, you must fulfill your end of the deal. This can expose sellers to significantly larger losses, which is why selling options is generally considered more advanced and carries more risk than simply buying them. For now, though, the most important thing you can take away from this video is the core structure. Options are contracts with an expiration date, a strike price, and a premium. Calls are for bullish bets, and puts are for bearish ones. Buying options limits your loss to the premium paid while offering potentially significant upside. And leverage is a double-edged sword that can multiply both your profits and your losses. If you are just getting started, the smartest move is to take your time with the basics. Paper trade or simulate trades before using real money. Study how options prices move in relation to the underlying stock. And do not let the excitement of potential big wins push you into trades you do not fully understand. The most successful options traders got there by building a consistent, disciplined system over time, not by swinging for home runs on day one. Options trading has a learning curve, no question about it. But once you understand the foundations, you open up a completely different way of participating in the markets. Smash the like button if this helped you, drop your questions in the comments below, and subscribe because we have a lot more content coming that will take your understanding of investing and trading to the next level.